Ohio Investors Group. We are going live here again this Wednesday, as we try to do every Wednesday at noon. We are going to be talking today about the big question that we get from pretty much all of our buyers out there right now is, should I wait? Should I wait for that next big deal? Should I wait for interest rates to come down? Should I wait? Should I wait? Should I wait? What are the answers? Well, we don't have the time machine to be able to go forward and say, this is what happened, and look back and say, you should have done this. But what I can tell you is the way history repeats itself, it's pretty simple. If you're talking to your father in law or your grandpa or your grandpa's grandpa, they'll tell you, hey, I remember back when a candy bar was a nickel, and that nickel was wooden. Ultimately, what they're looking at is the prices when they were young. Well, we have inflation, we have changes in markets. We don't even use the gold standard anymore. There's all kinds of differences that change, and prices go up. The candy bar is never going to cost a nickel again. And if it does, it's going to be like this big. It's never going to be the king size candy bar that we all remember as a kid. When I was little, they were 35 cents, but my grandpa was complaining that they were a wooden nickel. That's just how it is. Well, now candy bars are what, like $2? Sometimes they're even
Yesterday
more.
at the airport, I spent $5.35 for a small candy.
But kids nowadays are going to someday think that that's a bargain. And that's what I want to do with real estate today and investing, is get people to understand that now is a time. It doesn't feel like it because of something we just maybe came out of, but it is a great time to still get into investment real estate. So let's talk about a few things first. We classify markets three different ways in real estate. There's a buyer's market, there's a neutral market, and there's a seller's market. Cheech, tell us how those things break down for the.
Well, even before we get into that, what you were just saying, the fact is, whether it's real estate, stocks, bonds, whatever, if you're trying to time the market, you're going to lose.
Yeah.
All right.
Yep.
Just that's the fact. You're going to be lucky if you time the market. You're better off just making the moves that make sense. Period. Now, with that, a seller's market is, okay, first off, let's talk about what an equal market is. We normally look at an equal market at being about 6 months of inventory, meaning that if nothing new hit the market today, ever again, based on the number of sales we have every month, we'd be out of houses in 6 months. And that fluctuates between 4 to 6 months is what's considered more or less an equal market when you're in that range. Now, we've been in a dramatic seller's market for the last couple of years. All right. In fact, if you go back to like September 2021, we had 0.8 months of inventory, meaning we didn't even have a full month of inventory. Now it's gone up, it's improved, but it's still quite the seller's market. We're at right now for Summit County, Cuyahoga County's at 1.9 months, Summit County's at 1.4 months, Medina's at 1.5 months. So we're still in a dramatic seller's market as it is.
Say that one more time. Say that one more time, and loud and clear.
We are in a dramatic seller's market.
And that's what I want to get at, is there are so many news stories. They put all these headlines out there. Anybody and everybody that tries to post on YouTube tries to be dramatic with their thumbnails and stuff and says, we're in a changing market, it's a buyer's market, blah, blah, blah. But the reality is they don't know what actually qualifies as a buyer's market, a seller's market, or anything else. We are still in a seller's market, and it hasn't changed yet.
So now we've got a long ways to go before it becomes a buyer's market. That's for sure. Now, granted, the market has changed.
Sure.
However, we still have a really long here. We've got a real long ways to go before we're in an actual buyer's market,
or even until we get to the neutral market.
Yeah.
So we're still in a seller's market where things are going well, and typically real estate is behind a little bit. So we'll see more of the results of what we're dealing with right now in about 6 months. But the bottom line is when we're dealing with investment properties, whether the interest rates are low or high, whether the price of the home is low or high, we take four things and we look at them to say, is
Wait, you want a quick trivia? When's the last time you think we were in a neutral market, guys?
anybody?
Not
So
talking buyers.
2012, 2013.
I'm not talking a buyer's market, but a neutral market. Last time we were in a neutral market was the beginning of 2016.
I was going to say 2015, but 2016 was that, huh?
Yeah. And in 2015, we were actually still in a seller's market. We had a little blip that brought us into a neutral market, then back into a seller's market. We've been there ever since.
So here's the challenge when you're talking about markets. And everybody always has an excuse of why they can't buy or sell investment properties in these markets. Because if I'm in a seller's market, well, prices are too high. Because why? Because I'm competing with other buyers. I'm not necessarily competing with the seller. I'm competing with other buyers on the price of that home, and often I pay way more. Well, then interest rates start to go up and we start to shift back into a buyer's market. And all of a sudden the prices aren't so high, but the interest rates are real high, and now I can't afford it then. So if the prices are too high and I can't afford it, and the interest rates are too high and I can't afford it in these different markets, at what point can you afford it? And I want to break it down in a couple of different ways, because there's four things that we should be taking advantage of when we're looking at investment properties, and those are cash flow. And cash flow is the number one. And just like anything else with today's society, we get greedy when it comes to cash flow, and we look at how can I cash flow now? How can I cash flow tomorrow? As soon as I close on this, I want to buy this one property. I want to quit my job and I want to retire off of this duplex that I'm buying. Is that a reality even in a great market? No. We did have a market that we just exited where you could still find properties that did cash flow a few $100 a month if you were buying single family or duplexes up to all the way up to fourplexes, but you weren't quitting your job and you weren't retiring off of these properties even in that market. So that's a myth first off. But a conversation that I had with a really good friend that I've been friends with for 20, 30 years. We were on vacation a couple months ago and he started asking about real estate. Now, I don't want to talk about real estate on vacation, but this is a good friend of mine. And when it comes to investment real estate, I kind of look at myself as a financial advisor when it comes to that. And what I told him was, if you're looking to get into investment real estate to retire early, it's probably not the best option to do based on your lifestyle, because you're not prepared for property management or anything like that. But if you're looking to offset your social security and whatever retirement savings that you have and create a monthly income based off of this is a great way to go, because the cash flow numbers that we look at should be down the road. When we retire, we're either going to sell that property because we're making less income and we're going to pay less taxes on it, or we're going to keep that property and we're going to get income off of that property. And all the time in between we've used to pay down the mortgage or pay off that mortgage. And that's where cash flow really matters. Not year one, not day one, but maybe year 20, year 30, depending on when you're going to retire, is what we should be looking at when it comes to cash flow. The other thing we're looking at is appreciation. How much, if I buy this property today and I let the renters pay the rents down over the course of 20 years and I retire in 20 years, how much is that property worth now? So we've got cash flow, we've got appreciation. We got one that barely anybody really talks about, but it's the depreciation. What can I use to depreciate and actually reduce my taxable income while I own this house? That's a huge one that barely anybody gets into. Maybe that's actually a topic we can use in a live video in the future. Yeah. But that's one we rarely talk about. And then we have the fourth one. It's debt pay down. So if I'm collecting rents on it and I started off with a mortgage, maybe I don't have huge cash flows, but my property is appreciating, and every time my tenant pays rent, I'm able to pay that mortgage down and my equity grows.
Pay that mortgage down and write off that interest back to that depreciation.
Great point. So what happens is you start here, appreciation goes this way, debt pay down goes this way, and look at that, all that equity we have in between, especially come year 20, year 30. So when I'm talking to my good friend that I was on vacation with, What I was talking to him about was let's buy a property that just makes sense. It's in a good location. It's low maintenance. Maybe the exterior's brick or vinyl or aluminum or something like that. Something you have to paint all the time. Has good windows, furnace, newer roof, things like that. Maybe it doesn't cash flow real well at first, but you bought it. Now it starts to do this. And when you get to those retirement years, all of a sudden, now I've got it paid off or close to paid off, and I've got an extra $1,000 a month or $1,800 a month in income that will offset my Social Security. So I'm using a different vehicle. I'm not using stocks or bonds or anything like that. I'm using investment properties to create wealth and build income over time. And that's why I call myself a financial advisor when it comes to investment properties, because I'm not trying to help you strike it rich day one and cash flow $1,000 when you're getting a loan at 8% interest rate using hard money lender. It just doesn't work that way. But if you
making good, intelligent moves.
Absolutely.
You know, and here's the fear. What you started this conversation off with is the fear of, oh, geez, you know, should I buy now? You know, what if the bottom falls out? That's what they're reading in the national news. And, you know, I just saw a great chart which showed our trend line of house appreciation over the years from like the 70s all up, and it got to 2008 and the bottom fell out. Remember that?
Yep.
We were in the business then. The bottom fell out. And that they extended that trend line now. By 2018, we were above that trend line. So even if you bought a property in 2008 at the peak and the bottom fell out, and you continue to collect the rents, you're already over that trend line.
It's called buy and hold for a reason. You know, it's not buy and get rich quick. It's buy and hold. And when you hold it over time, whether it's a stock, a bond, or even real estate, if you hold it long enough, it's going to make money. And that's what we should be looking at when we're doing our interviews of new investors and things like that. Is their strategy to get rich quick, or is it to offset some of their retirement income? So I took a property. Go ahead.
I just want to say, you've mentioned the offset retirement income a couple of times now, but you think about it, if you're a new parent, what a great way to put your kids through college. Buy those rentals down.
I love it.
You know, it doesn't have to offset the retirement. It can, but it can offset that $40,000 a year college plan.
Well, you and I both have a friend that bought a rental property near a college that's close here to home, and he has 4 or 5 kids, and he told all his kids, hey, you can go to college here and have free housing the entire time you're there. And all of his kids stayed in the same house, and they rented that house. Not only did he sell it for way above what he was able to buy it for, but his kids lived there for free, and he got rental income that whole time. And then once his last kid graduated, he sold the property and moved on down the road. But that was a great way to offset the expense of college, because they never had to stay in the dorms or anything like that because it was their property. So it was a great decision on his behalf and based on the price that he got it for. Let's take a property.
He said, I have a friend. I don't have friends. I'm Frank, the man with no friends.
No, you know who I'm talking about. So let's take this one property. I grabbed this property yesterday. I was just trying to run some numbers on it, and I'm struggling right now. When I run numbers, I was so used to coming out with good cash flows that with these higher interest rates, it doesn't always work out that way. So I pulled this property yesterday, and I took a look at it, and I was thinking, how in the world can I make this property make sense? Go ahead and pull it up if you could. So this property here, it's a side-by-side ranch duplex up in Sheffield Lake. Great place to live. Rents were good, everything like that. But at $190,000, I wasn't even making my 1% return on that property when I looked at my rents. So what I did like about the property, I like its location. I like that it's low maintenance. I liked everything about this property, but my rents weren't getting me there based off of what interest rates are right now. So let's take a look at the spreadsheet real quick, because I just wanted people to see this is a real property. Note, before you switch it over real quick, I want you to note that yesterday I looked at this property and it was active. Today I'm looking at this same property. I thought it was like, this one barely works, but look at the status of this deal right now. It's pending. It's under contract.
Yeah.
So somebody
No
else
showing, so inspections are done.
somebody else saw the value in this property based on what they were looking at, just like I'm seeing that same value because they looked at it
Yeah.
through a different set of lenses.
I'm wondering too, just right off the bat, just looking at this listing, you've got, they're side by side duplicate properties. They're probably the exact same floor plan. One's renting for 740, the other one's only renting for 575.
Yep.
My guess is he hasn't raised rents in a while.
And I looked on the Bigger Pockets calculator, and the potential rents, the median rent was about 900 and 950. So that's where it was just a hair below that 1% rule when it came down to things. But I'm looking at it thinking, okay, even with it being at 1%, with interest rates being at 7.625, the numbers just aren't working. So let's pull up the spreadsheet and look at how we analyze these properties. So up at the top, I've got my price and everything in, and I've got that interest rate using a 30-year fixed loan. And if I scroll down to the bottom and I look at what are the overall numbers on this property, the first thing that we've been looking at for the last 2 years is going to be the cash flow. It's going to keep going down all the way down to the bottom.
Okay, you
I
want
want
the
to go to the
ratios?
percentages, yeah. So right here, if I look at my cash on cash return, it's only 0.88%. Back in January, this would have been much higher because I was getting the loan at 3%. Same property, still going to be a great property over time, but right now, because of interest rate, it's only 0.88%. Even if I paid full price, what I want you to do is I want you to quit looking at that year one column if you're an investor. Look at it year 5. The same property, same interest rate and everything, now it's making 7.52% if you increased your rents 4% year over year, just like you should. Now it starts to get interesting. Now it's at 7.52. Return on investment without appreciation is 10.83. Not a bad investment. What if interest rates go down during that time and you can refinance that? Now these numbers go even higher. What if you take those same numbers from year 5 and you put it out to year 20? What do those returns look like? This is a great house, a great vehicle. Unfortunately, it's already under contract and nobody can buy it, but this is a great vehicle for somebody to get into, look to retire someday and have some additional income. Because once this property's paid off,
8,
Right.
9%, 10%.
Again.
Yeah.
You're right. Right. Where are you going to get the? You cut out on us, Blaise. You froze for us.
oh, sorry.
But you're right. Where are you going to get 5.64% return on your money today, right now, and it just goes
And
up.
not have it be something that carries a lot of risk.
Right.
Yeah.
Right.
Right. And what if you use that 10% return to aggressively pay down that mortgage and you get it down to $0 come year 20, and that's when you're going to retire? Well, now you've got $1,800 a month in rents that is coming in that will offset what you were making with Social Security or other retirements. An additional $1,800. It's actually way more than that because I'm not even factored in 4% increases over that time. In year 5, you're already up to 2187 is our rents, I think, for the total. So imagine year 20, rents are going to be much higher, and it's just like the price of that candy bar.
Right. Right.
Where it was a
And
wooden.
the whole time that asset is growing.
Yep.
I mean, just the appreciation alone, that thing will continue to grow. You've got your write-offs going on. So in this particular case, in this particular case, you can also offset other income by $1,200 a year in the first year.
Okay.
So, I mean, you just got to make smart moves. There's an old Chinese saying: the best time to plant a shade tree is 20 years ago. The second best time is now.
Yeah,
So,
I always use a baseball analogy. There's base hits, and then there's home runs. This is certainly a base hit, but enough of those wins a ball game.
Right.
Another way of looking at it, I was watching one of the Bigger Pockets podcasts, and the guy said, this is eating your vegetable. This isn't the steak. This is the broccoli on the plate. You got to have some of this on the plate to stay healthy. And having a
Wait,
property.
I know for a fact you won't eat broccoli.
I won't eat broccoli, but let's call it asparagus, maybe. I'll do that. But bottom line is, you got to have some of that stuff to have the vitamins and nutrients and stuff to stay healthy. Unfortunately, it's not always what tastes best, but to start here, especially if you're a first time investor, this to me is a home run for a first time investor because it's ranch style. There's plenty of people in retirement that need that one floor living. The exterior maintenance is very low. The roof was newer on this property, and it's in a great location where when jobs fall off, you're not immediately going to have people out of work and not able to pay rents. Often,
Does that property have a basement?
I believe it does. That one did have a basement. I looked at quite a few yesterday, but if you look at the
full basement,
there you go, and a one-car garage, so they can have the washer, the dryer.
Chances are, because that garage is in the middle, those basements are separated.
Yep. Utilities are all taken care of by the tenants, I think, except for one thing. I mean, bottom line, this is a good property for somebody to start off with. But what it won't do is it's not going to cash flow in year one based off of the numbers that are readily accessible. We shouldn't be always looking at, especially in today's environment. We had all these investors that wanted to get in on properties when there were bigger cash flows there. But now all of a sudden everybody's falling off. It's the market as it shifts, it gets better and better for people to get in on these. And right now, to me, is a time where people should be looking at a retirement plan because this candy bar is never going to cost a wooden nickel again. It's only going to go up from here. And 20 years from now, somebody's going to say paying $3,000 a month in rent is nothing to them because inflation happened, life happened, and the cost of the dollar and stuff all changed. And it becomes the norm, just like back when the wooden nickel was the norm. $3,000 income off of this property for 2 units would be a no-brainer.
Should make a good house hack too.
Oh,
it'd make a great house hack.
So explain that real quick. House hack. How's that work for you guys?
Well, you're gonna basically looking at being able to rent out the one side. You're living there. What's principal and interest on this one at 190?
Here, principal and interest. Well, don't forget, if you're doing a house hack, you're going to have a much better rate. So if I'm looking here, and my principal and interest is 1,008 right now, but since it's a house hack, it's going to be.
And change your money down too.
77.
Change your amount of money down too. I mean, you can get in way less if you're doing a house hack because it's owner occupied. Great point, Scott. House hacking right now should be something that all parents are recommending to their kids that are living in their basement on the couch or whatever, and they want them out.
So you've got people that have newborns that want to get college. You've got people that want to get their kid out of the basement. House hack. Even if you've got a co-sign with them, you now own a piece of this property.
Well, the reality of it was, if you go back to last year when interest rates were 3%, if you're a parent and you wanted your kid to move out, the only way that they were getting out is if you were lending them some money for the down payment anyway, because they had to pay so much over the appraised value. So some way, shape, or form, you're contributing to help them get out of the house and get out on their own. And this is a great way of doing it because once they decide to move into their final single home, now they can keep this property and collect rents on it, and it just helps them so much more down the road. I wish I could go back in time and do it myself.
Yeah, same here.
All right, guys, I think this was a great live session, and we covered many, many reasons why waiting should not be an option. Bottom line is the wooden nickel is not going to buy the candy bar anytime soon. So let's encourage everybody to get out there and buy an investment property in any market for that matter.
All right.